Yes, good evening, students. Very good evening to all of you. Good evening, Amit sir.
Thank you, sir. Thank you, Rajiv ji.
I welcome all of you students and I welcome Amit ji, who is learned faculty for the today's session, and today's session is on substantive testing. Amit ji will continue. He has also delivered last lecture on substantive testing and he is a wonderful orator. Students, आप बड़े ध्यान से मैं आपको कहूंगा जो ऑडिटिंग के लेक्चर एग्जामिनेशन में हेल्प करेंगे. दीज सेशंस आर वेरी यूजफुल स्टूडेंट्स बिकॉज जो आपको प्रैक्टिकल इंसाइट्स मिलेगी. सेशंस का नाम ही ऑडिट इंसाइट्स. तो आपको जो प्रैक्टिकल इंसाइट मिलेगा इससे, इन लेक्चर से, आप उनको बड़े ध्यान से सुने और आपकी जो नॉलेज है, नॉलेज बिल्डअप होगा. और जब स्टूडेंट्स नॉलेज बिल्डअप होता है तो उसका कोई सब्स्टिट्यूट नहीं होता. वो आपके अंदर ही चीज जाके आपके माइंड के अंदर जाके उतर जाती है और फिर आपके लिए एग्जामिनेशन को हैंडल करना बहुत आसान हो जाता है. तो स्टूडेंट्स, मैं आप सबको यही सजेस्ट करूंगा, ये लेक्चर जो है आपको बहुत जबरदस्त सपोर्ट करेंगे ऑडिट को पढ़ने में, ऑडिट का नॉलेज बिल्डअप करने में और ऑडिट को एग्जाम में आपको एग्जाम राइट करने के लिए. तो स्टूडेंट्स, वेरी यूजफुल दीज लेक्चर्स आर बिकॉज प्रैक्टिकल इंसाइट्स आपको यहाँ पे मिलेंगी. जो आपको पढ़ा रहा है स्टूडेंट्स, वो आपको जितने भी साल का एक्सपीरियंस है, 15+ ईयर स्टूडेंट्स प्लस ईयर्स का एक्सपीरियंस है अगर, तो 15 साल का एक्सपीरियंस वो आपको डिलीवर कर रहा है. बड़े ध्यान से सुनना चाहिए और बड़े अच्छे तरीके से सुनना चाहिए. साथ में नोट्स भी बनाने चाहिए. और फिर आप जब ऑडिटिंग साथ साथ आप प्रैक्टिकल जो आपका, जैसे चैप्टर 5 है हमारा, ऑडिट ऑफ आइटम्स ऑफ फाइनेंशियल स्टेटमेंट्स, जिसपे पूरी सब्सटैंटिव टेस्टिंग, पूरा सारा चैप्टर 5 इसी पे है, ऑडिट ऑफ आइटम्स ऑफ. और स्टूडेंट्स, आपको डिफिकल्ट भी मैंने देखा है, स्टूडेंट्स जो बात करते हैं तो उनको चैप्टर 5 बहुत डिफिकल्ट लगता है. तो इससे आपको चैप्टर 5 इजी लगेगा. यस, विद दीज वर्ड्स अमित जी आप स्टार्ट कर सकते हैं.
Okay, thanks a lot, Rajiv ji, for giving us a background. And so we did cover couple of topics, I will say, in the previous class. And I ended up my last session by saying if there is any questions that you would like to ask, because when the session is going on, there is a high probability that not all the questions that you will be facing will come across at that given point of time. So I requested all of you, if in case you will have any question from the previous session, then we can start our today's session from those questions only. So I'll pause for a couple of seconds while I'm sharing my screen, and I would request if you have any questions, you can write down, and Rajiv sir can help us with your queries. And if you don't have any queries, then we can move with today's session.
अमित सर आप स्टार्ट कर दीजिए, फिर बीच में क्वेरीज होंगी तो आई विल इंटरप्ट इन
Okay,
बिटवीन और फिर आप आंसर दे देना सर उनका.
perfect. So, dear students, in today's session, we are planning to cover four substantive testing areas. In the last session as well, we covered two areas. In the today's session, we are going to cover revenue, how to do the testing of revenue, then PP&E, which is property, plant and equipment. We will also touch base on trade payables, and then the last one will be statutory dues. We are expecting like each one of it will take around 30 minutes, but we will see. If you would want me to spend more time on revenue, because significant and fraud both risks will be there, then we will spend more time on revenue. Okay, going forward, you see revenue TOD. So when we are talking about revenue, revenue is generally a substantive and a presumed fraud risk area. I hope you understand these terminologies, which we covered in the last session as well, and your previous sessions with other teachers as well. So since revenue is a profit and loss account or statements item, the FSLI that we discussed last time, which is financial statement line item. We call it FSLI in the audit, right? So revenue is an FSLI, but when we are talking about revenue as an FSLI, this may further be divided into the KBPs. Or in the last class, last session, we discussed like FSLI is different than the COTABs. COTABs is basically class of transaction, account balance and disclosures. So how to do the testing of revenue? First of all, when you are coming across any industry, any company, the revenue ledger or FSLI can be divided into quotabs. So class of transaction is what you need to identify. What is class of transactions and how it is different than the FSLIs? So like giving an example, let us suppose I'm auditing one company and the revenue is actually presented in their profit and loss account. Before I will plan my audit procedures on the revenue itself, I need to see that what are the various class of transactions which are there inside the revenue. Now the class of transactions, they are basically the sub service lines or sub revenue or product lines of the company from where the revenue is being generated. This is a group of the transactions which are of similar nature. That is known as class of transaction. So when I'm planning some audit procedures on revenue as an FSLI, I will see what are the various areas from which the company is generating those revenues. Okay. So like I was giving an example of a company which may have two class of transactions inside revenue, one being the online sales, the other one will be offline sales. Both of them can be different, right? So like for online sales, what is the process that we have and how these processes are relevant or related to the different GLs in the financial statement, those GLs which are summing up to the trial balance. So we need to see online sales, how the process is there, then offline sales, how the process for offline or let us suppose showroom sales is there. So these subgroups of revenue will become class of transactions. And that's why in audit, we discuss not about FSLI, but we discuss about class of transactions. So I hope you can recall significant class of transactions, material class of transactions, and non-material class of transactions. Coming back to how you do the testing, the first thing that you need to do when it is coming to revenue is to identify the right class of transaction so that you can start doing a walkthrough. You can sit with the process owner and understand how the online revenue is being initiated as a transaction, how it is recorded, how it is processed, and how it is then reported. Right? Recording and reporting are different. So when we are talking about class of transactions in revenue, there are various like assertions. So these assertions are at an FSLI level, and these are the risks which are associated. To give an example, like first one is the completeness. We need to see that sales made, but they are not recorded in the books. So completeness is a very important assertion. Specifically, if you see, there is a probability that if a sale is being made, but that is out of the books, we need to understand how to check the completeness. So when we are doing as an audit procedure, what I will be performing, I perform generally cutoff testing around year end and reconcile dispatch records with the sales register. I'll show you a template as well, whereby and how what are the various kind of procedures that I'm performing on the revenue I am documenting. I'll take you to the respective template and then we can go one by one all the tabs and how these testings are documented. You need to understand that what is the cutoff testing. So if I want to ensure the completeness, it means as per the matching concept, the revenue of a particular period should be booked in the against the expense of the same period. So what I need to do is basically I need to do the completeness using the cutoff. What is a cutoff? Like in the practical environment, I have told you in the previous session as well. This has always remained a very practical question as well, the interview question, whereby people generally ask you if you want to do the cutoff testing, what do you understand by cutoff testing and how you do it, how many days will be selected during the cutoff testing. So what happens, just to give you an example, like if I'm auditing one of the company, like offline sale is there, I know if a customer will come to my showroom, the billing will be done then and there. It means the rewards, risk and reward will be transferred. The revenue should be booked then and there. But any other class of transaction like online sales, if a customer is ordering something, it may take couple of days to complete the transaction. In those cases, there is a high probability that the management will book some sales which are not there, which shouldn't be there, right? Which actually give rise to a kind of a fraud, a kind of a risk. And the management is always under pressure to show the highest level of revenue because there at times their targets are there, they need to achieve those targets. So at the year end, when these things are there, when the revenue is booked, it becomes very suspicious. It becomes, I mean, a fraud risk is there. So what we need to do, that at the end, whatever number of transactions, sale transactions are booked, they are all kind of actual sales that were made, right? So the management is also aware. So in the practical scenario, what happens if I am creating an invoice on 31st March and I know that, let us suppose, the terms of sale is X work. X work means outside factory. So as soon as the goods will be sent outside factory, the sales can be booked because now the risk and reward is transferred. So in those cases, the management will obviously always want that by 31st March 12 midnight, the maximum trucks should be dispatched from the factory so that all these goods transfer note or goods issue notes they signed.
Amit
Okay.
sir,
So on 31st March,
sir,
yes, sir.
sir,
Yeah, please
font
continue.
size. Students are saying font size is very small. Can you enlarge the font size?
Yeah, I can do it.
Yes, sir.
So I mean, it's a template basically. It's a work paper which generally people use. I hope.
सर वो
Is it visible now?
अभी विजिबल है सर, यस सर।
है ना?
थोड़ा छोटा काफी आ रहा है, आप इसको थोड़ा सा और बड़ा कर दो सर, अगर पॉसिबल है तो आपके लिए।
हाँ हाँ, कोई दिक्कत नहीं। I can increase the size. Is it better now?
यस सर, इट इज बेटर नाउ सर।
Yeah, okay, perfect. So this is
इट इज
just
बेटर
like
नाउ।
a template where I'll be recording the cutoff testing. Okay, so cutoff means that the last number of days transaction, couple of transactions. So if you go in the audit, you will realize that there is a practice of like 5 days of cutoff. People generally test.
सर स्टूडेंट का क्वेरी है सर।
Yeah, please sir.
स्टूडेंट की क्वेरी आप पूछ रहे थे ना अभी।
हाँ 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 हाँ,
एक
please.
स्टूडेंट ने पूछा है, इज सिस्टमेटिक अप्रोच वर्कआउट while conducting substantive test or else procedures has to be flexible?
So it is basically company to company. It's not even the industry. So cannot be a systematic. So what happens to answer the student? There are couple of procedures which are very systematic or standard. I will say they are in nature, standard in nature. Like to give an example, cutoff procedure is something that you need to perform to ensure the completeness. Now this cutoff procedure, even though this is a standard procedure, and we all have to perform if we are doing our revenue testing, but how many days of cutoff will be taken there? This cannot be standardized. It has to be customized as per the industry and as per the client. I was just giving you an example. If I have a client, I have a company which is totally into offline sales, right? Maybe there is no need to do a cutoff testing because the moment they are booking the kind of sales invoice is the moment when risk and reward is transferred. The customer is taking the goods and then they are going away. So there is very, very minute to minute kind of a risk that a fraud will happen or the sales will be overbooked, especially during the cutoff. But if there is an online sale, there is some level of possibility that the revenue cycle can be misleaded, especially in the offline sales when you are dealing with, let us suppose, overseas sales or the goods are being transferred from one place to another place. I was just giving an example. If a customer is there and your risk and rewards says that the sale will happen when the X work conditions are there. X work condition means the moment the goods will be out from the factory, they will become the property of the customer. In those practical scenarios, the management will be under the pressure to release the goods as soon as possible. It means by midnight of 31st, they will try their level best that all the goods are dispatched outside the factory. But in practical world, what happens if the risk and rewards are being transferred when the goods will reach to the customers go down? Okay. In those scenarios, even though all the sales that are booked on 31st March by management may not be the actual sales because by midnight of 31st the goods were still in transit, okay, and then those sales which are booked, they belong to the next year's sale, not this year's sale, and that's why a cutoff is really important. So if I'm, let us suppose, if my company, the class of transaction, the process that I'm talking about, if it shows me a revenue booking cycle of 5 days, it shows that a transaction will be completed in 5 days, then I will take 5 days of cutoff. It means by any dispatch that happened on 26th, there is some chance that the risk and reward was not transferred by 31st. So I will test all the last 5 days of transactions and I will see when actually the risk and reward was transferred. And if because of any reason If the risk reward transferred the next year, I will ask the management to reverse all the entries, all the sales that they booked in this year because the risk and reward was not transferred. This is known as cutoff testing. But if that let us suppose the cycle was only for 3 days, okay, then I will do the testing of cutoff for 3 days. So to answer again, I mean, standard procedure is that I will perform cutoff testing, but it cannot be standardized for the, I mean, industries or class of transactions. We need to understand whether we'll be doing 3 days or 5 days, and that's why it is our favorite question because generally when people are studying about the students are going through these situations, they generally consider 5 days as the standard cutoff days, which is not the case. So I hope I answered your query as well, and I explained how the cutoff is working. Okay. So we need to make a proper work paper, which is basically a template, which is visible right now. In the templates, when you are preparing, you have to mention that why this template is there. So you need to do, these are the class of transactions you see. So if you can see like domestic sales are there, and then how the domestic sales are being booked. Last 15 days of revenue for all intercompany except this company. So they are saying for intercompany company in company terms where 15 days of revenue is there, we need to do this testing for 15 days. But otherwise, generally the 5 days is the cutoff period for any transactions. For
अभी सर
export,
फॉन्ट साइज फिर थोड़ा सा लार्ज कर देना सर.
okay, I think this is an Excel, so that's why maybe. Is it better?
Now it is better, sir.
Okay, perfect.
Yes,
So
sir.
this is basically I'm just showing a template how to kind of record this. So this is the revenue cutoff, and in this we need to mention the class of transaction, a little bit of understanding of the processes, how the domestic sales are booked, and then how the export sales are booked, and then you need to actually you need to mention why are you taking 5 days, 10 days, 3 days of cutoff. You have to show that justification during the reviews, be it PCOB reviews, be it your peer reviews, be it your NAFRA reviews, they generally ask this very prominent question that how you decided that 3 days of cutoff is to be tested or 5 days of cutoff to be tested. And in the audit, I told you in the last session as well, not documented, not done is the principle. So you just cannot tell in that meeting room that this is how you decided. You need to actually show them that in the work paper how you concluded. So you need to document everything. Okay. So this is how you do a kind of like a documentation around the cutoff testing. Then you will be writing down the sample selection methodology as well. Is it like all the samples that you will be taking or not? And then there are various in-company terminologies. Like work, I told you, work means factory. So when goods are going ex factory, your revenue recognition can happen. But when in terms of like FOB is there, until or unless your goods are not loaded on the ship, you cannot book your revenue. So let us suppose a sales transaction is happening, but your goods are on the port. The terms of the sale are FOB. So you send the goods to the port on 31st March. The management will book an entry. They will consider this as a sale, right? Because the goods are on 31st March, they are on the port. You as an auditor, you need to test it. You need to tell them that the goods are on the port. The FOB documents, shipment documents are not complete. It means the risk and rewards are not transferred. Anything that will happen to those goods, if that will happen anything, it will be a loss of the company. So this stock is actually a property of the company. It means company cannot recognize sales. They have to reverse the sale. So you will definitely ask them to reverse the sale, and with the entry that they did basically trade receivables to sales, they have to reverse it. Okay. And then there is a new entry which will be booked. I hope you can understand because goods are not in the factory, so they may book another entry whereby they can reduce their stock and book stock in transit, right? Or sales in transit. I mean, they are just control ledgers. The moment the sale will happen, they will transfer this to the sales account. This is how generally in the practical world it happens. But if the sales were happening, let us suppose CIF basis, in the same transaction, even if your goods have been boarded on ship, the FOB documents are complete. But now the terms are CIF, cumulative of insurance and freight. It means you cannot book sales until the goods have been transferred to the port of the other country. It simply means that if the goods are in the ocean on 31st March midnight, all those sales have to be reversed. The company cannot book sales. So we need to be very careful because the management is always under the pressure to meet the targets to book the sales during current year. And this actually gives rise to a lot of fraud risk, which I was discussing, because of which the sales targets can be met. So as an auditor, you need to identify the cutoff and then you need to check the documentation around then when the risk and rewards were transferred so that you can go back and you can ask the management to reverse it. Okay. Now, after the memo, so this is more or less like the first template, first tab of any template that I'm discussing. It is generally a memo, which shows that what is the background of the company or the policies that the company has. The second tab generally that we prepare is more or less like the work done. It explains the summary of all the other tabs, how the kind of documentation is being done, and then what is the work done that the audit team has done. So for this work paper, for this template, what is the objective? The objective is to ensure that sales reversals have been accurately recorded, if any, that was supposed to be recorded. And if that is the sales reversals, as an auditor, what we have done. So this is the work done. You cannot create a document without work done. We call it self-explanatory documentation. Okay. In the audit, if you have to sit with your manager or partner to get your work paper reviewed, it means the documentation is not up to the mark. They should be self-explanatory. So if you are busy on one client, you can simply send this documentation to your seniors, and your seniors can simply go through the work paper to understand where the areas of concern are, what are the differences and everything. You need not to explain it to everyone. That's what I told you. When you will be facing a review, no reviewer will ever ask you to sit with you and make them go through to the documentation that you have done. They will simply pick up your file. They will take it from the archived folder or archived server, wherever it is. Every company do the archival of the audit files. Once the sign off will be complete, the audit file will be logged and it will be archived on a server. None from the audit team will again have access to that file. Nobody can edit that file anymore. So that archival policy is there with every company. It means if there will be a reviewer who will come to review anything, they will simply take the file from that archive folder. They will not be asking the managers or partners to submit the file because submission, like some kind of intervention can happen. So they'll be taking the file and they will start going through the documentation that you are preparing. So you have to write everything down. Documentation is the key in the audit. Okay. And if there is anything missing, let us suppose they are not able to identify or they are not able to understand how you have decided your cutoff testing days, they will make it as a query or they will make it as a finding in the conclusion. In the report of review that they will be publishing, they will mention your firm's name and then they will mention that these kind of challenges or the lack of documentation was there. So it has to be very thorough. Like in the work done, you can see like what is generally is written that we have performed sales cutoff testing for last these many number of days of the financial year. We need to justify why these days. We have obtained the sales register for this period and documented client remarks on the selected population. Okay, so last 5 days, whatever sales are there on the sales register, we have taken the remarks. We have selected samples out of this based on professional judgment and obtained customer purchase orders, sales invoice. These are basically proof or evidences through which you can establish when exactly the risk and reward were transferred. Fourth one is basically like we have reviewed the purchase orders to verify incomplete terms, PODs to confirm the delivery dates. We have verified the sales reversal entries as confirmed by the client, and we have reconciled the sales reversal balance arising from the cutoff adjustment. So whatever uh, transactions that you believe shouldn't be recorded as sales in this year, I mean, it is not like the sales will not be recorded. We are talking about cutoff. The problem is that this sale does not belong to this year. So we will ask the management to reverse on 31st March, and if they want, they can book subsequently, maybe on 1st April or 2nd April, because this is a sale of the next year, not of the current year. And then we need to conclude as well that no material discrepancies are left after the testing that we have performed. This is basically just a work done tab, that this is what we have done. Now the actual testing that you have done, this is the tab in which you need to write that what is the company name, what is the year for which you are doing the audit, who prepared it, who reviewed it, everything is written. Okay. So you're saying, delivering plant, these are the transactions that you have taken as. So this is more or less like a sales register. So they are saying like this is the sales register for last 10 days. So they will mention all the details and then we'll be picking up samples from this. Okay. And these samples will be tested. So these are the samples that we have picked for this. And then there will be, at the end, there will be various attributes. Okay. So these are the, what is the customer PO number and all these details. Just imagine, right? We need to fill all these details to conclude that these transactions were actually belonging to this year only. Okay. I hope the screen is visible. I am just increasing the font size for the benefit of everyone. But this is how we document actually, practically. That this is the cutoff testing. Now the sample testing summary. Okay. So this is basically, you see, if it is an X work sale, what has happened from this plant to this plant, amount as per the client, amount as per the XYZ, and difference, if any. Right. So this is basically if we have taken any kind of sample and we know the balance as per the client as well. 4.1, this is basically various types of class of transactions. So these are the class of transactions which are there. I mean, class of transactions is the basically business cycles, revenue cycles. So we have like an offline model and on-site model. So you have to do the cutoff for different class of transactions separately. So if the company is earning, let us suppose from 4 business cycles, there are 4 revenue cycles that are simultaneously happening. One is for the domestic client, the other is for the overseas clients, or maybe domestic but offline, domestic but online. In the same manner, of overseas, offline, overseas, online, or maybe a kind of a specific transactions like sales to government offices, sales to private parties. I mean, maybe it is like it's kind of an wholesale transactions. B2B transactions are happening. B2C transactions are happening, which is business to business or business to customers. So, I mean, you need to understand the revenue as an FSLI, that what are the various nature of revenues they have. And for each class of transaction, which is like the similar kind of the processes, you have to do cutoff. Because for each class of transactions, different cutoff days can be there. Okay, while some may be instant sales, some may take 3 days, some may take 5 days or 10 days. And then you need to mention that why are you taking 3 or 5 or 10 days. Okay, so this is how. So for each class of transaction, you have to do this particular testing, and then you need to see that how many sales are actually reversed at the end of the day. So this is how you document cutoff, a thorough cutoff documentation. Okay. Coming back to the slide through which we started.
Sir, which you have explained, like for
Yeah.
each class of transactions, revenue transactions, can you explain it by way of example, sir?
Yeah. So I gave an example like this uh, revenue. I took an example like maybe. So I'll give you a practical example. One of the company we were working with,
Yes, sir.
this was selling products to hotels as well, right? And then they were selling it to the customers as well. Okay, products, soap, etc. Those kind of products. So they created 2 types of cycle. Okay, one is the cycle which is the class of transaction which they started calling it Horeca sales. It means hotel sales, restaurant sales, cafe sales, right? So that was the Horeca sales. The other one was the direct selling to the customers. Now when they noticed it, direct sales to the customers is having, it is a class of transaction, right? A group of customers who are being directly sold by the company. For these kind of transactions, only the cutoff was same day, right? It is one day only, the cutoff. So if you want to actually check, you need to check it on the 31st March as well. But when we actually discussed and then we went into detail, we realized that that is not the case. Even for the domestic clients, they have 2 sub-cycles internally. It means they are selling directly to the customers, but there are a couple of customers who are being delivered on the same day because they bought the products from the company's website. but the company's products are listed on other websites as well, like Amazon and all. And if a customer is purchasing from there, it is taking actually 3 days to complete the transaction. Okay. In the same manner, when we realized Horeca, while the company was telling us that it is like 5 days is the general time, which is it takes from receiving the order, creating an invoice to reaching to the product, to the customer. It means they were saying the 5 days is the business cycle, revenue cycle for this particular class of transaction. But when we inquired, we realized that the restaurant sales maybe they are being converted into 3 days only. But while the hotel, the bigger chains may take only 2 days, right? And maybe the cafes, etc., they can take 5 days, depending upon the volume of the products. So instead of deciding a blanket, like we'll be doing cutoff testing for all 5 days for every kind of a sale, we decided like direct sales to the customers, which is business to customer B2C model. In that, taking 5 days of sample will only waste our time. It will be over audit or excess efforts, so there is no need to do it. If I really want to do the testing of cutoff for that particular class of transaction, which is business to customers directly by the company, only 1 day of cutoff is sufficient. So we picked up sample for 1 day instead of 5, right? So if we are actually picking up 1 day sample, there is still a kind of a risk that some transactions where the revenue cycle was not 1 day, they could be booked even though they were related to the next year. Okay. And vice versa. If we are actually increasing the kind of size of days, then it is not that risk only, but it is over audit. Then the efforts will go in vain. If we can identify, we can conclude that 3 days of cutoff is sufficient for a particular class of transaction. You need not to put efforts for 5 days because it will be over audit. But if in that case you will do cutoff only for 1 day, then there is a fraud risk that the over revenue will be booked. So you have to make a balance basically, practically. And that's why you need to conclude why for each type of class of transaction, what should be the cutoff days. Okay. I mean, before I'll move to the slide, if you have any other questions, I mean, on this particular template, I'm all ears. I'm happy to listen. Okay. So quickly, if you see the revenue, these are the basically risks, assertions, and these are the risks. So when we talk about WCGW, initially when I started reading audit, I used to think that this is very much theoretical, or I mean, this is kind of not a lot of bookish knowledge. But when we started doing it in the practical environment, we realized that every single word that is written in the audit, that is very much practical in nature. There is a whole logic what goes behind after the each word. So when you're talking about completeness, it shows that the revenue is complete. Complete means, as per the matching concept, the revenue which is supposed to be booked during this year is the only revenue which we have booked. And to ensure that, what is the audit procedure? You will be doing performing cutoff testing. You see, if you will read only this line, perform cutoff testing, you will find it very theoretical. But I showed you a whole template, how much effort it goes actually internally to do that testing. Okay, and it's not only doing cutoff testing, but how many days of cutoff is to be tested, that also takes time to decide. Then we have accuracy. I mean, accuracy simple means that there is a probability that the revenue invoice, let us suppose, of 100 rupees was there, but you ended up doing it only or booking it, recording it only for 80 rupees. So these kind of instances can also occur, and that's why you need to test the samples of during the sales, during the year, right? So that's why you need to come up with a sample which you need to run on the revenue transactional register. So you will be asking the client, you will be saying, like, I need the transactional register, the whole of the TR that you will be receiving. You will run the samples on that. So this is how you do the audit procedure is basically that you will recalculate the invoice amounts and verify price list or contracts to ensure that basically this is the price. Now you see it's not only
Sir, can you
yeah,
explain the difference between this completeness and cutoff assertion?
the third one.
Yes, sir. Completeness, you are saying that audit procedures perform cutoff testing.
Yes.
And what is the difference exactly in between cutoff assertion and completeness assertion?
Okay, so cutoff is basically which means that the right revenue is booked during the current year. Completeness asks you that everything that was supposed to book it is booked during the year. So a simple difference is basically cutoff actually addresses a risk whereby something was sold during this particular year, which was the risk and reward was transferred in the next year. This is the cutoff at the year end, right? So cutoff creates a problem that, let us suppose if there is something sold on 31st March, maybe the goods actually reach to the customer on 1st April. It means on 31st night, if anything would have happened to those goods, it was the loss of the company. It means that sale should be reversed. It is not actually a sale. It is maybe sales in transit. This is what we do when we ensure cutoff. But when we are talking about the completeness, we are saying completeness means anything that was supposed to be booked during the year, it has been booked. Okay. It can not only be cut off, but it can be during the year as well. To give you an example, sir, like let us suppose I am into a property business, okay, and I am booking the rental revenues. So I'm getting a lot of rentals, and my trial balance says that that is revenue. Now, when I'm talking about the cutoffs, I am saying on the last day, that is 31st March, the cutoff is something which may not be making absolute sense in this case because we are not doing any transactional testing over here. But completeness says that still, if we are not doing a cutoff, there is a probability that all the rent from all the properties that was supposed to be booked for March month, there is a probability that is not booked. So what we will be doing in that case, to specific do the completeness testing, we may do an analytical review. So what I can do, I can see how much or how many properties are there, what is the monthly rent, and then I will come up with a substantive analytical procedure, which we discussed in the last session as well. And I can run that. So let us suppose for each month, the rent that I was supposed to get is 20 lakh rupees. For the complete year, the ledger should tell me that the total revenue is 2 crore 40 lakh rupees. I will match it with my trial balance. And if it is not matching, that is what the analytical review is all about. Then I will conclude that the completeness is not there. I will go back to my management, I will sit with them and I will check with them whether the revenue correlated to, let us suppose, March is booked accurately or not. There is a probability, right? Like for the March month, there were a couple of properties that were vacated by the tenants. The revenue was not booked for those properties, or some XYZ reasons. Maybe during the year the rent was increased. But I would request the management to give me answers for that rather than me going and finding. That's how you do completeness testing. So, in simple words, cutoff means the risk at the end of the year because there is a possibility revenue of this year may be booked in the next year. But completeness means whatever revenue during the year as well that was supposed to be booked, whether that is booked or not. So that's the difference. So did I answer your question or should I explain it again?
Very well explained, sir. Great, sir. Great explanation, sir.
Thank you, Rajiv ji. Now we are talking about accuracy. Accuracy means the revenue that was recorded, that is recorded, whether that is commensurating with the invoices, the amount, or the prices. I'll give you a practical example. Right now, I'm handling a client which is very complex in nature, and the client is booking the revenue on the basis of percentage completion method. Okay. Now the point is when we are talking about the accuracy, the company has a policy which is allowed by the US gaps as well. So they are booking the revenue on the basis of percentage completion, but they are ensuring the profit margins or contribution margins to be remain similar or remain intact. So what happens actually? Like let us suppose I signed up a contract, a long-term contract for 100 rupees, and now I am expecting that we will have 80 rupees of costing throughout the project. It means on this project, I am expecting to earn 25% margin on cost. So 80 rupees of the costing is there and 25 margin is the 20 rupees, which means 100 rupees of revenue will be booked. But now this 100 rupees is something that I need to generate or book in 10 years, 10 upcoming years. The problem is this is a kind of a comprehensive arrangement. It means this will involve your products or your services as well. To give you an example, like let us suppose you have a air conditioner at home. Now this air conditioner, you sold it to the customer in, let us suppose, 50,000 rupees. So you can book the revenue of that 50,000 rupees in this year without any kind of confusion, because that is a revenue which is known as point in time. And then you can do the cutoff as well, if whether the risk or the goods were delivered on 31st March or not. So that is the cutoff. But whether that sale, every sale of AC that was supposed to, that is happened, whether that is booked in the books or not, that is your completeness. Okay. And accuracy is basically the amount that you are booking. So maybe if I sold 500 units, all 500 units are booked, but the problem is the amount is not correct. What I'm trying to say over here is, like for air conditioner, when I'm talking about an air conditioner, they may give you a 5 years of service. So they are like, you pay us 50,000 rupees and then we will give you a warranty for 5 years. So anything that will happen, be it servicing of the air conditioner or any replacement of a part, this all will be taken care of by the company, but you need to pay 5,000 rupees. And we are giving 50,000 rupees and they are giving you 5 years of warranty or 10 years of warranty. Now the problem is that as a company, you don't know how much revenue is to be recognized. Because if I am getting 50,000 rupees for 10 years of warranty, I cannot book 5,000 rupees every year, because you see there is a cost which will be different. In the initial years, the AC will not need that much of services. The product replacement will not be that high. So the company has to come up with a projected file that out of total 50,000 rupees, we will earn 10,000 rupees as profit. So it will become 25% on the cost or 20% on the revenue. That's the margin. But this 40,000 will be spread across the 10 years. Like this cost of 40,000, initially it will be less. So initially I will book only 2,000, 5,000, these kind of revenues. But at the later stage, it may go up to 7, 10,000 rupees per annum. I have to book my revenue accordingly. It is not like I'll be doing a revenue on a straight line basis in the 10 years, because this is a comprehensive arrangement. I am doing products on services, both of them. Right? That's a very practical kind of a situation. So in that case, whatever cost I am booking, so let us suppose in the first year, I am booking a cost of 2,000 rupees. You know, the revenue will not be booked 5,000 rupees. The revenue will be booked because I am generating only 25% on cost. So if I'm booking 2,000 rupees as my cost for this year, the revenue will be 2,000 plus 25%, which is 500 rupees. 2,500 rupees of revenue will be booked in this year. But what if company is booking 5,000 as a revenue, saying that they have a contract and this contract allows them to get 50,000 rupees from customer in next 10 years. So they are doing it on a SLM basis and booking 5,000 rupees. The whole of the accounting will go for a toss, and that's what we call it. The accuracy is not there. So you need to go back and you need to challenge this. I mean, this is the same thing happened in Byju's. I hope you can recall the incident whereby, I mean, the auditors were changed. I don't want to take the name of the auditors and all, but you know, one of the big four left the Byju's, and then one of the top 10 firm came in picture to do the audit of that company. Accuracy was a problem, very big problem. I mean, they were selling the contracts for 3 years, 5 years. So, I mean, if your kids are there, you can buy a 3 years contract from Byju's. But the problem was that they were recognizing that 3 years of a contract revenue in the year in which they were receiving that revenue, which means accuracy was not correct. And when the before actually pointed it out, the Byju's were not ready to reverse it, because this will actually lower down the sales, and it will impact their the market value as well, right? They were somewhere around $22 billion as a market valuation, you know. And since they didn't agree, the Big Four has to resign, and it become a very big market news. The other firm, the top 10 firm who signed up as a new auditor, they also didn't agree to the accounting treatment, and because of these kind of, I will say, malpractices, the valuation of Byju's, you know what happened to it. So accuracy is, this is how you test the accuracy.
तो इसमें कट ऑफ assertion भी तो सर इम्पैक्ट होएगा और completeness भी इम्पैक्ट होएगी.
Yes, sir. So what happened when we are talking about specifically about revenue? Revenue is a presumed fraud risk. Okay, so it means when it is a fraud risk, it is a significant risk for me, and I have to actually do the testing for all cutoffs. Okay, so these all cutoff, all kind of assertions testing is there. So we don't do testing, I mean, especially for significant areas. So what happens if there is a significant area? We call it FSLI, financial statement line item. And then we need to go to the class of transaction, which I was trying to explain. Revenue is an FSLI, while the online sales and offline sales is a class of transaction. So when I'm deciding that a particular class of transaction is material, I have to do the testing on all assertions. I need to identify risk and I need to draft my audit procedures, and then my team will be working on ground and completing this testing. Okay. But if there is an FSLI which is only material in nature, not significant or probably fraud risk, but only material because it is above my materiality, then I need to decide which one assertions are relevant. So not all the assertions will be relevant in that case. And if I'll decide, let us suppose only completeness is a problem for me, then I will only plan completeness audit procedures on that material uh, item. We call it MCO tabs: material, class of transaction, account balance, or disclosures. Any line item which is above materiality. That's how we do practically. Okay, so this is basically a revenue TOD. So what you do in revenue, to summarize, we do the transactional testing, whereby we pick up the samples from the transaction register and then we do the accuracy testing around those transactions, whether the revenue that is booked is correct or not. So we need to go back to the contracts, we need to go back to the customer requisitions, we need to go to the POs, sales orders. Then that's how the accuracy is being tested, that the amount is correct. TOD. We need to do the completeness testing. For that, generally we do the analytical reviews, which I just mentioned, along with the cutoff. Then we need to specifically do the cutoff testing, which is more or less like the at year end or the next year as well. At times we also check the next subsequent 5 days to see if there is any transaction that was supposed to be booked in sales on 31st March. By mistake, the company might have booked it in the April as well. Because remember, it is not like over or under valuation of a respective class of transaction that is relevant for me. We don't call it under or over. We call it misstatement. So in audit, we use the word misstatement. It may be on a underside or maybe on a above side. You see, one of the, I can recall one of the company, a shoe manufacturing company, Reebok, if I can recall correctly, they continuously booked uh, sales to their related parties only without showing it in the books. So there was another company which was created and then they continuously kept on selling to that particular company. When the auditors checked the relationship, they were not able to establish any relationship between these two companies. So it was considered as a unrelated party, non-related party. And when the auditors asked for the confirmation, the company sent the confirmation as well. All these testings that we did actually from a completeness accuracy cutoff perspective, there was nothing kind of as a fraud, sense of fraud was not at all there because all the documentation was already in place. So in those cases, in those kind of situations, it becomes very difficult for an auditor because an auditor has its own audit has its own limitations, right? You just cannot challenge. So if you come across a particular invoice and let us suppose you are buying an Apple Watch, and the Apple Watch is being sold somewhere around 40,000 rupees, somewhere around 45,000 rupees, somebody is selling in 48,000 rupees. As an auditor, you cannot check or you cannot kind of challenge it that why are you selling it in 40,000 while others are selling it in the 45,000 rupees. The reason is because company may tell you that this is an ongoing brand or campaign or XYZ things, and all you need to do is to check whether the relevant approvals are there in place or not. So if there is an approval to sell, let us suppose the company is allowed to have an approval from CFO or finance controller to sell a particular product as a special transaction in lower than what they generally do, then as an auditor you cannot challenge that, but you can only ask for those approvals and all, right? If the amount is not that big. Yeah, if the amount is material, you have all the rights. Okay, company cannot say a no to you because then in that case it will be a restriction on the scope of auditor, which is also not allowed. So if it is not material, I mean, generally we don't get into that depth. Okay, otherwise it will become a fraud. Generally, like students at your level, they ask us what is the difference between the audit and the forensic. That is the difference, because in auditing, you do audit, you give opinion, you don't give certification. In the fraud investigations, you are going and checking all those aspects which an auditor will never do, because then it's not going to be an opinion. It is the factual report which will be there. It will not be a certification either. Okay, so they will not certify, but they will give you a factual report. Okay, so this is all about revenue. I mean, there is a lot that goes into, but yes, what I wanted to share from this session's perspective, I think we have covered. If there is any question on revenue, we can address them, or else I'm moving to the next FSLI.
Yes, sir, you can move to the next part, because what students are asking, I am telling you, sir, the students' questions, sir.
Perfect, sir. Now coming back to the property, plant and equipment, PP&E. Now PP&E is a balance sheet item, like revenue was a P&L item. This is a balance sheet item. So in the last class, I told you that the assertions are different for a balance sheet item and for a P&L item. While we are talking about property, plant and equipment, obviously depreciation, which is related to property, plant and equipment, it will be a P&L item. Okay, so this is one of the kind of a balance sheet item which has impact at both the places, P&L and PP&E. In this, we are covering PP&E, but while explaining, I will explain you about the depreciation as well if required. Okay, so at a balance sheet level, we have existence, completeness, rights and obligation, and valuation and allocation. These are the assertions for a balance sheet item. So when we are talking about property, plant and equipment, okay, we need to see that what are the risks that we can associate to these assertions, and then what are the audit procedures that we perform. So the first risk around the assertion is existence. It means the assets which are there in the books, they are not recorded. Assets recorded, but they are not there. Sorry. So existence means the assets in the balance sheet, they are visible, but they are actually in reality, they are not there. And it happens. Actually, like in practical life, you see when you're dealing with clients which are listed, like hundreds of locations they are covering, and then you don't know if a asset was purchased, is actually purchased in one of the branch or in one of the factory, whether it is actually existing or not. So it becomes very challenging for an auditor to know whether the capitalization of a particular asset that is happening in the books, whether it is there or not. Especially if it is not a very material asset, right? If it is not like a factory, a plant or machinery that is being there. Just to give an example, like on an average, any listed company may have thousands of employees, right? But let us suppose one laptop is being purchased. Now, as an auditor, it is not that material. But in reality, you don't know whether that laptop is actually purchased or not. So existence is a very big risk. And how you can ensure that existence is there? Okay. So the companies, they are supposed to have tagging of all the assets that they are purchasing. Each asset that they are purchasing, there is a asset code that is allocated to it, right? And then they need to maintain a register which is known as fixed asset register. In auditing, we call it FAR. Okay, FAR, fixed asset register. That register should show all the assets that the company has, along with location, tag, ID, and everything has to be there. The management is supposed to do a physical verification of assets as well. If not on annual basis, then at least they need to cover all the assets in a cycle of 3 years. That is what is recommended. So when management is doing that kind of a testing, auditors can also participate into it. Auditors have all the rights to go and practically see or ensure the existence of an asset if that is of a material nature. As an auditor, I mean, obviously, you will not like to see all those. So, like, just I gave an example of a laptop. So, what we do actually, we ask the client the list of all the laptops that are given to the employees, and if required, what we do, we pick up some samples like 5-10 employees from that list, and then we send email confirmations to the employees, and we ask them that please share the laptop ID or laptop model number, etc. that is given to you by company and the date on which it was given, whether it was a new laptop or an old one. So this is how kind of we check the existence. So what we can do as an audit procedure, we conduct the physical verification and then we are reconciling it in the asset register. It is not only the physical verification. You see, just imagine a factory is there. As an auditor, you might not be even aware about that what are the parts which are used in various plants and machineries. It becomes very difficult at times. I'm being very practical here, that if a management is standing with you and they are saying, sir, this is the particular part which we purchased, and this is the tag ID, or this is particular a product which is 5 lakh rupees. Now you don't know, at times it becomes very difficult for you to commensurate that what management is saying, showing, or what is existing, whether they all are matching or not, right? So if they are saying this part is there, I mean, as an auditor, you don't know what is the use of this part, where this part will be fit into that machinery, and is it actually that part only which is being capitalized or not. So I mean, as an auditor, if you really think there is a requirement of involving any expert, then that is also doable. Okay. So if you think that the asset seems material, maybe you have a doubt on let us suppose completion certificate. You think the installation certificate that the client is showing you is not appropriate. I mean, in the cases where you think you have significant reasons to doubt, you can involve a management expert, or you can involve an auditor's expert. Both of them can be there, right? So you, if you want to consult, if you want to take any certification from, let us suppose, management expert, you can reach out to them. And if you want to involve any auditor's expert, you can do that as well. So existence. Okay. Then the completeness. Completeness means all the assets that are purchased, they are not recorded. You know, like in other terms, it at times, you know, like the completeness is becoming more challenging, because you see what happens at times if there are repairs and maintenance. Just to give an example, and company don't want to show these repair and maintenance in the P&L, because it is an expense. It is going to impact the P&L. The bottom line will be impacted. You know what company may do? They can show this repair and maintenance as the capitalized item. They can increase the FAR, because they can capitalize those kind of assets, those kind of expenses which are revenue in nature. And if it is happening, actually, those assets that are being capitalized, obviously that will spread across the upcoming years as an expenditure, because now depreciation will be there. It's not like in revenue expenditure. But then the completeness will remain a problem, a very big problem. You just cannot ensure that all the assets that are purchased are actually assets, or everything that is getting capitalized, whether it is capitalized or not. So you need to identify whether the capital expenditures are actually capital in nature, whether those expenditures are increasing the substantial life of the asset or bringing any efficiency in the asset. Why? And I mean, what is the reason or basis on the basis of which it is capitalized? Okay, so completeness is what you do by taking samples. Rights and obligation, assets recorded, whether they are owned by the entity or they are not, and then valuation and allocation, whether the depreciation, etc. calculation is correct or not, whether the assets which are kind of impaired because of any XYZ reason, if there is indicators of impairment that exist, you need to definitely see whether the property, plant, and equipment have been gone through an impairment assessment or not. Okay, so this is how it is. Uh, in one of the audit, actually, what happened with us, like we saw, so I was a junior auditor at that time, and I actually came across a situation whereby loss on sale of fixed asset was mentioned in the profit and loss account. So this is a kind of a very general situation, and I also audited it by calculating that what is the gross block of the asset. Just giving an example, like 100 rupees is the gross block, and then I realized there is an accumulated depreciation of 80 rupees. So the net block became 20 rupees, right? And the company ended up selling it in 15 rupees. So 5 rupees of a loss that was booked by company in the profit and loss account. Now this is a very practical situation. So I audited it. I actually went through the bank account to see the receipts were there, you know, and the goods issue note was there. Everything was there intact. But when I sat with my partners for review, I mean, they asked me a very different question, which I never thought about. So they asked me, Amit, if there is a loss on the fixed asset, what is the reason why we charge depreciation on the assets? My question was because of the normal wear and tear. And the answer from the partners were not only wear and tear, but we want to make the assets value equivalent to the market value. That's also a reason, right? Because now the asset is used, it is wear and tear is there because of any XYZ reasons, the value is decreasing. So the whole purpose of the appreciation is that the value of the asset is matching with the market value of the asset. So when they are trying to sell a particular asset in the market and then there is a loss on the net block, it means the company is not able to fetch the value of net block even. It means the depreciation policy is not correct. It means the company, the depreciation that they are charging on that particular asset is not appropriate. So if the company would have charged depreciation appropriately, the loss would have never occurred. They actually, like with this small incident, they actually challenge the whole depreciation policy of the company. And the management has to justify why the depreciation policy that they have, that is that is fine, that is okay, that why and how they can go ahead with that kind of a depreciation policy. They came up with a memo with subject matter experts. I mean, this is what I never thought, to be very honest, as a junior auditor, that this kind of a situation, just by looking at a loss on sale of fixed asset. Okay, so practically, I mean, things are really very difficult. Not difficult, I will say, but different. What we study theoretically. Okay, I'll quickly show you how to do. I mean, how do we document all this? While we'll be discussing PP&E, people generally face a question in interview, which is what is the difference between the depreciation recalculation and depreciation analytical. Okay, that's a very kind of a common question. So I told you property, plant and equipment, one leg of PP&E goes into the P&L as well. So the depreciation that is calculated in it becomes very difficult to check the accuracy of the depreciation. With nowadays, the ERPs, SAP, Oracle, those kind of softwares, what is happening actually, none in the organization, no organizations are calculating the depreciation manually. What happens at the month end? All they do is they do a batch processing. On a click of a button, the depreciation is automatically calculated by the system. Basis the fixed asset register which is maintained inside the system, and the date of installation, date of purchase, date of put to use, everything is captured already in that register. So system is automatically calculating depreciation and putting it in the ledger. Now, as an auditor, you can see that there is crores of rupees of depreciation that is sitting in the P&L, but you don't have any calculation. Even if you'll go back to the management, they'll be very honest in telling you that, sir, we don't calculate it, and please don't ask us to show you a manual calculation on all this. It will become kind of a very tedious task. So in those cases, how you will do audit of depreciation, etc., when you know it is automatically actually captured by the system. So in those cases, we have to involve our IT audit. We go back to our IT audit team, who are professionals in IT, and they have some knowledge of audit as well, so that we can talk to them. So when we go there, we ask them the system which is calculating depreciation automatically. They need to do the ITGC testing for that, right? ITGC testing. I mean, it is the general computer controls which they need to test around that application. They need to do ITEC, which is IT related automated controls, right? So they need to come back with their report whether the controls that are established by the company inside the software, inside the application to do all this calculation automatically, they are correct. They do that logic testing that the formula which is run inside the system when they do a batch processing, the formula is correct. They also have to test whether during the year this formula was changed or not. So you have to heavily rely on ITGC and ITEC testing by your IT audit team, especially when these kind of situations are there. But since the ITGC or ITEC team is not going to do the signing on the financial statements, the risk of the financial statements will still remain with you. So to avoid that risk, even though the ITEC and ITGC clearance is there, you still have to do depreciation analytical or depreciation recalculation. Now it becomes a very important question in the interviews that what is the difference between both of them. Okay. So when you talk about A recalculation of depreciation, it simply means that you are running on that particular FAR, you are extracting the FAR fixed asset register, and then you are putting a formula in the Excel. Let us suppose you're putting a formula and then you are mentioning how to calculate that particular depreciation. So you put a formula on the basis of the date of uh, kind of installation, date of put to use, and then if it was sold during the year, you will do that. You will also have to see, I mean, the formula is also not easy because you have to see any asset which is there. Let us suppose, as per the policy, if it is less than 5,000 rupees, you might find that there is no depreciation which is calculated because anything below 5,000 rupees, they are just leaving it as a nominal value and no depreciation is calculated. So this is a little complex formula, but you do it at a kind of a line item level of every line item, and then you just create a formula and then you do a copy paste for the rest of the line items, and it gives you a total value of depreciation that should be there. You do a comparison of this particular depreciation recalculation that you have done with the total depreciation in the profit and loss account. And if there is a significant difference, you need to go back to the management for explanation. Okay, or you might have to check your formula if there is something wrong with the formula itself. On the other side, when you were talking about the depreciation analytical, generally depreciation analytical is a procedure that we perform when the less complex environment is there, but that is what we, how we do it basically. Rather than going at a line item level, we do a average of date of, let us suppose, put to use, or probably we do an average of the depreciation for a particular block of asset. And then we calculate this not at a line item level, but at a block level. Okay, like for property and for buildings, we are doing in one go for the complete building block rather than going it for each building as we do in the depreciation recalculation. So a very basic difference is that depreciation recalculation is happening at a line item level, while the depreciation analytical is happening at a block level. Okay, block wise or group or category wise. So that is a property, plant and equipment. I'll quickly show you how to document this as well. So over here in the depreciation, in the PP&E, what we do a TOD. TOD means test of details. It is the sample testing. Okay, sample testing. So what I do the addition testing. I do the deletion testing. So I am doing the addition for new assets which are added to the FAR fixed asset register. We pick up some samples and then we see whether the date capitalization date is correct or not, whether the amount is correct or not. So like see, this is the template. I hope the font is visible. Okay. So for property, plant and equipment, PP&E audit program,
Visible,
what
sir.
are we? Yeah. Okay.
Yes.
So what is happening here? The first step, as we shown in the revenue template, it remains like the template of audit program. That how are we planning the PP&E? What is the audit program? So we'll be doing like a roll forward testing. Okay. In the roll forward testing, we will schedule prepared by extracting opening balances, addition, disposals, depreciation. So since it is a balance sheet item, you need to see what was the closing of last year, what is the opening of current year. I mean, this is also a opening balance testing is a, very important audit procedure that we perform. Before you can start doing the sample testing or closing balance testing, you need to ensure that the opening balances are correct. Like the last audit closing balances, audited financials closing balances should be carried forward. I mean, it should not be like there is any difference in the opening balances. In the practical world, we are very honest. I mean, we have found that these differences are also there, right? That the opening balances are not matching with the previous year testing, especially where you are the first year auditor, especially where this is a new client. So roll forward testing is there. Then we will be doing additions TOD. This is what I was telling you. The new additions in my PPNE, I'll be making addition testing. That is line by line item samples testing to see the block is correct, the depreciation rate is correct, capitalization date is correct. I mean everything. So or the amount is correct. There is a probability, right? The company may take input credit of certain taxes. but they are still capitalizing it over here. So that is correct or not? I mean, we can reduce the value of the asset and then we can go back to the company asking them to claim this in input credit instead of uh, taking this as a depreciation in the subsequent years. So that is what we do during the addition testing. In the same thing, like we do the deletion testing. I just explained, like when I was doing the deletion testing of one of the fixed asset, I came across this loss on sale of fixed assets. And then even though I did the TOD and I was kind of happy that all the evidences around the transactions I was able to check, but my partner kind of suggested me that the depreciation policy is also something that we need to test. It's not the only deletion. Then I'll be doing verification of useful life, whether the useful life is correct or not. Depreciation expense, I told you, right? This is recalculation or analytical that when I need to perform on depreciation. IP testing of FAR. IP is basically, I mean, this is a very important concept, even though I didn't plan this to cover, but since it came in front, so I'll see IP is basically information produced by entity or provided by entity, right? Now, what is IP? Anything that the management is giving. The market
Recording in
value of the asset is
progress.
not matching with the net block asset, value which is available there. So we check the policy, and once we are settled, then any addition that will be happening to that block, it automatically picks up the useful life. Practically, this happens. I hope, Hima, I answered your question.
Saminathan, one
Yeah.
student is saying that, sir, no audio and no video, please check. I asked, is there any problem from our end? I asked. Yes, students, I do not think there is problem on the audio and video. Though there is, I think, no technical problem from our end. You can check your own connection. Saminathan?
Yeah, so I can clearly listen Rajiv sir, and I hope
Hello.
Rajiv sir can also see the screen, right?
Hello.
Ayaz?
Yes, sir.
Ayaz, is there any problem? One student is saying no audio and no video.
No, sir.
Saminathan?
No, sir. It's clear. It's clear, sir.
Yeah.
I think there is no problem from our end, student. You can check your connection.
Okay.
Yes, sir. You can continue, sir.
Yeah, perfect. So this is what it is. This is what we do in the PPNE testing, which is property, plant, and equipment. I hope Hema, your question was answered. Now, the after the audit program, where we have written, audit program is all about what we are going to do. So these are the procedures, and what we will be doing in the procedure is also written in the audit program. So, I mean, you see how and what level of documentation is there. Even if a junior to junior auditor, if you, let us suppose you join a company and you become the auditor with us, the moment we will give you this template, either there will be somebody to explain you, to help you, but even if your seniors are busy, let us suppose, they don't have time to explain you, these documents are self-explanatory. And if you will look at the previous year file, you will find that everything is already tested, everything is already maintained. While doing the roll forward of those documents, you will get to know that how to perform what is supposed to be performed. And that's how we maintain standardization across the form. So if we have 20 partners, I mean all 20 partners, and
Sir,
there are hundreds of clients that are
sir.
running. Yes, sir.
Actually, Hema, you answered the question of you very well answered, sir. The question
Yeah.
asked by Hema, that
Mm-hmm.
how practically useful life is verified.
Mm-hmm.
So Hema, there was disruption, I think, at your end when you were also facing no video, no audio. हेमा
Mm-hmm.
सर हैज एक्सप्लेन कि ये फैक्ट्स के ऊपर डिपेंड होगा, कंपनी के फैक्ट्स के ऊपर, और जो कंपनी जो वैल्यूएशन करे इसकी लाइफ, डिफरेंट एसेट्स की डिफरेंट लाइफ होगी डिपेंडिंग अपॉन द फैक्ट्स ऑफ द कंपनी, कि कंपनी
Right.
कैसे, कंपनी का यूसेज, जैसे सर ने बहुत अच्छा एग्जांपल दिया, लिफ्ट का एग्जांपल दिया, जैसे कि लिफ्ट की लाइफ कितनी है, एक कंपनी के यहाँ बहुत ज्यादा यूज है तो उसके 4-5 साल, 3-4-5 साल लाइफ है, और एक कंपनी का बहुत ही कम यूज है तो हो सकता है उसकी 10 साल लाइफ हो। तो सर ने बहुत ब्यूटीफुली एक्सप्लेन किया ये इसको
Mm-hmm.
एग्जाम्पल के थ्रू। तो आप इसको इसी कंसेप्ट को एक्सटेंड करें सर, आप भी एक लाइन में एक्सप्लेन कर दो सर,
हाँ
ताकि
हाँ.
हेमा को क्लियर हो जाएगा सर।
So Hima, the point is, it depends on the useful usage of the company. That's what I told. I think Rajan sir explained it pretty well. So what happens? We test the depreciation policy of the company. In the depreciation policy, it has already written that which type of block of assets will have how much useful life. And we test that particular company's policy. We initially, if we want to test it and run it through with a subject matter expert, we involve those subject matter expert as well. But once we are comfortable with the company's policy of useful life and depreciation on various block of assets, any subsequent addition will automatically be allocated into that block, and then it will be kind of allocated under that useful life of category. That's what I told you when my partner suggested me to go back and check the depreciation policy. His his question or doubt was very simple. That if let us suppose there is an asset which is supposed to be depreciated in 5 years, but we might have allowed them to depreciate it in 6 years. That's why their net block value is not matching with the market value when I'm going to sell this particular asset, right? Maybe because it is retired and whatever the reason is. And that's why the loss on sale of fixed asset is there. Otherwise, loss on sale of fixed asset will never be there because the purpose of depreciation itself is to to have the net block of the assets. Uh, I mean, in alignment with the market value of that asset. Hema, I hope now it is clear.
ये परफेक्ट सर।
Okay. So moving ahead, this is basically an audit program, how the audit program is being made. Then we have this PPNE lead sheet. Now you see, when I mentioned what is lead sheet is actually, like for each type of FSLIs, these are FSLIs basically, financial statement line items. This is a balance sheet FSLI, PPNE. So there is a certain ledgers, GLs, which are clubbed under that FSLI. So like for PPNE, the client may have hundreds of GLs, right? Depending upon how big the client is. Okay. So they may have GLs of ERP, SAP, GL codes are there, and then these GL codes will be clubbed and will become one PPN. Okay. So when we generally get the trial balance from the client, there are a lot of line items. But these GLs which are there in the trial balance, they will be grouped in couple of FSLIs only. So FSLIs may be 20, like this PPNE is one FSLI, but it may have hundreds of GL accounts. Okay. So what we do, the first thing that we do is to break the trial balance into various FSLIs, right? Because I have a kind of a big team who's working on an audit. I cannot give the trial balance to everyone, because if I will do that, they will be confused that who is working on which area, who is taking care of which particular GLs. So what I need to do is I need to divide the whole trial balance into FSLIs. So I will pick a portion of the trial balance which is related those all GLs which can be grouped under PPMA. Okay, and I will call that portion of trial balance as lead sheet. Okay, so that's in the audit. Lead sheet is basically a portion of the trial balance related to that FSLI only. So I'll need to kind of maintain in over here a lead sheet as well, so that there is no confusion. Right, for PPNE, how many ledgers I'm going to cover, what is the portion of the trial balance will be covered, this is the summary of that. Right, so for this is the kind of a summary that what was the cost, what is the depreciation, what is the closing net book value. This is as per the company, and then I'm doing it as per financials. You see, so in the balance sheet, these are the numbers, and this is what I'm telling you. These are actually coming as a grouping from various GLs, and then I'll be calculating a difference. So if there is a difference, okay. So this is the working. You see, the working that I have done. This will be automatically linked here from the previous tabs. Okay. The moment I'll be working on these next tabs, this will automatically calculate and come here, and this will be automatically be compared with the lead sheet, which is the numbers in the financials. Okay, and then if there is any difference, it will come here. If the difference is material, then I will inquire, I will do the discussion. If that is immaterial, I can ignore that. Okay, so this is the roll forward testing, which is basically, I didn't mention it's a balance sheet item. So you need to do the roll forward as well. That what was the cost in the beginning, what was the depreciation, and then the closing net block, and what is there in the financials. And this is FAR. Okay, so these are the tick marks, basically how you can put, like if there is blue in the color, then it means it is agreeing, it is tying up of the previous year financials. It is red, tying up with the additional testing. I mean, and then you need to put these tick marks at the respective cells. Okay, we call them testing attributes. Okay, that's how. So if this is a number, I know this is tested, and how this is tested. So this is, if you go in the tick mark, you can see that this is tested because we have agreed it to the prior year signed financial statements. So I might have taken the signed financial statements and did a tick and tie that yes, this number is correct. This is how the auditor uh, do the documentation. We discussed about audit procedure of physical verification. This is how you document that. So when we are talking about the property, plant and equipment physical verification, you write down asset identification number. If you can recall, I told you tag ID. Every asset will have a tag ID. So this is that number. You know, like, so when we discuss, like if you are calling a LE and then you are saying LE means legal entity. If let us suppose you are a group of multiple LEs, and you have an LE, let us suppose somewhere outside India. In UAE, there is a legal entity that is your sister concern, right? You're calling them and you are asking, hey, what happened to that particular furniture? Example. Now there is so much of confusion. There is so much of furniture they have. So they don't know which furniture you are talking about. So people generally don't talk like this. They talk in terms of the identification number. So they will be mentioning the identification number and then will be saying, can you please update us on this? I mean, when I used to take interviews as manager a couple of years back, there was a favorite question that I used to ask. I know we are not interacting over here, but I'll give you the question and the answer. Maybe just for benefit if somebody will ask you. We used to ask if, let us suppose you have purchased a TV of 100 rupees and you got a DVD free along with it. So there is a DVD player which came along with it in free. And you purchased this TV, let us suppose, for your office cafeteria. The cost was 100 rupees, but a DVD that you got is 20 rupees, which is in free. Now we generally ask in the interview that what is the accounting entry that you will be posting for this? And this is quite confusing for the students because there are students who are capitalizing the asset with 100 rupees and then making the payment from bank, but they are missing on the DBT. There is no entry for the DBT. And then we generally end up asking if you are not recording DVD, then DVD is something which is free in the books. And the finance manager or the finance controller may take that DVD to their home because it's not part of the assets. In the same manner, people generally they come up and then they do the 20 rupees of DVD booking as well. So they come back and then say TV 80 rupees, DVD 20 rupees, and then we can pay through the bank 100 rupees, which is also wrong because if that is the case, DVD you received it free, then you will never depreciate DVD. So you are booking an asset in 80 rupees, whereby the depreciation should have been claimed on 100 rupees because the cost of the TV is 100 rupees, and that's what is confusing. That's why we ask these kind of questions in the interview. But the correct answer is basically that if you are getting something in free, you have to record these things at a nominal value. Maybe 1 rupees, maybe 2 rupees, something which is nominal. So that a line item in the fixed asset register can be created. You will never depreciate this, never, right? So that this will remain every time you will download that fixed asset register, this will show as a line item, even if the value is not there. It means the company is always aware that there is a DVD player which is with them, right? And then because of the asset identification or tagging, they know what is the DVD number, what is the model number, and everything, so that nobody is never in a position to replace it as well, right? Like somebody came up with an asset from the home and then they replaced it with the company asset. That's also not doable. So this all we do during the existence testing. So physical verification, asset identification, what was the class, description, quantity, phase of physical value, physical verification. I told you, right? So they are generally, the management is covering this once in 3 years. So which one phase it was, the percentage coverage, how much is the total covered, right? Any other details as per requirements, and then this is the uh, financial statement or the FAR basically you receive from the FAR. So this is what the management tested. This is what was in the FAR, and then you see whether it is matched or not. In the same manner, you check the title deeds of the assets which are there, and then you document it like this. What was the location, building purpose, address, date of agreement, document verified, right? So all this, I mean, again, I'm saying not documented, not done. Don't tell me actually, like what you have done. Show me. That's how we behave in audit. Please don't come up that there is something that you have completed. Please show us that you have completed, right? Then the useful life, how are you testing? So somebody was asking about useful life. This is what you do for the useful life. Useful life considered by management, right? This is the class. This is the management considered useful life as per the Schedule 2 of the Companies Act. If in case the asset is required to be in that block of Companies Act. Otherwise, if reasons are different, then you can mention. Like we gave you an example. Uh, Elevator is being depreciated in not in accordance with the useful life, then there can be kind of a policy which can differentiate. So all you need to do is to document the reason and have the expert valuers or your auditor's experts opinion on that. But once that is freezed, like a useful life, every time an addition is happening, you need not to do the testing every time of the useful life because then it will by default go into a block of asset and system will automatically pick that up from there. I see this is basically your addition. So addition testing, while you do addition testing means new addition of the assets. It becomes very important to notice that any revenue expenditure should not be capitalized. Okay. So what was the date of capitalization? How much is the amount and everything you need to record while doing the addition testing. Whether this is matching with your financial statements or not. That's also you need to cover. Same is with the disposable, right? It means the assets that you have sold during the year, you need to do the sample testing for disposable as well. I mean, there might be hundreds of items which are being sold, hundreds of assets, but all you need to do is to do a sample testing. In audit, it's not only sample testing. You see, when it comes to sample, there are two things. One is sample size. So how you will decide that only 10 samples are sufficient. If I'm saying hundreds of items are there, line items, how do you know you need to test 10 samples, 15 samples, 20 samples, right? There has to be a systematic method. Because if you are selecting 10 samples, your reviewers, right, regulators, they may come back and then they may ask, why 10 only? Why not 20? And if somehow you are able to justify that 10 is a appropriate number to get a comfort on this FSLI, there is a high probability they may ask. Then out of 1,000 samples, you decided 10 samples you will be testing. But how you decided that these are the only those 10? I mean, the 10 could be anyone, right? But then you have to also justify that how have you narrowed down to these 10 samples? I mean, what was the sample selection method? Was it random? Was it judgmental? Was it high value? Was it nth? Was it monetary unit sampling? I mean, is there any other tool that you used? How actually you calculate, ensured that, or how you narrowed down your testings to this particular samples. So number of samples and which one samples you will be testing. Both are equally important. You need to justify both of them. Depreciation expenditure. Okay, this is the analytical. So yes, we do calculate the depreciation as per income tax as well, because at a later stage, in the books of accounts, you need to book the deferred tax liability, deferred tax assets as well, and that will begin the difference between the depreciation as per the books and depreciation as per the income tax, right? Then this is the recalculation which I told you at a line item level. Then what is the recorded amount? And you just put the Excel formulas. Here are the formulas, and then on the basis of these formulas, you see that what is the total depreciation that was there in the books, and what is that you calculated, and what is the difference. So like in these line items, there is some difference which is there, but this difference is immaterial, so you can ignore it. But saying this, if you are doing this calculation at a line item level and this is immaterial, you also need to see whether in total this immaterial balance. So you are just writing immaterial, 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 but there is a probability that when you will do the total of all this immaterial account, this might be material. So in those cases as well, you need to inquire further. Then you need to identify those variances which are high in value, and for those specific assets, either you need to correct the formula or you need to write the justification. And then IP, I told you, information produced by entity. This is, I mean, without doing completeness and accuracy testing, you can't rely on FAR. Okay, so this is how you do the testing of property, plant, and equipment. And it covers by default depreciation as well, which I explained. Okay, so can we move to the next FSLI? I mean, if in case you don't have any
Yes,
questions.
sir. One student is asking,
Yeah.
Mr. Anil Kumar,
Mm-hmm.
is asking, while selecting samples for testing,
Yeah.
we need some expert knowledge. We to hire some experts in that case, right? As it is out of knowledge activity for the auditor.
Not at all. I mean, you're not supposed to, I mean, hire auditors for auditing, experts for auditing. You see, as an auditor, the law says that you should not be hiring experts for accounting, auditing, etc. Because the law expects you that you are already an expert into it, right?
No, but the concern the student is having, sir, in my opinion, he is into that it is these sampling is basically statistical technique, and
Right.
auditor might not be expert in sampling, sir.
No,
मतलब statistical techniques, sir. Statistical.
got, I got your point now. So, sir, what happens practically that we have firm approved tools. As an auditor, what we do, like in the auditing as a kind of a practice, I'll give you a quick example. Like you are not an expert in the AI. I'm just giving an example, but ChatGPT is something that you can rely upon or you are using. Again, that's a firm policy. Like we use Copilot in our firm. Copilot is something that you're not an expert in. You don't know the logics behind it, but it is a firm approved tool. As a practice, as an institute, as regulators, we all have agreed together that this is a tool that can be used. Okay. So in the same method, we have various tools for sampling as well. One of the tool I mentioned is monetary unit sampling, right? MUS, we call it in the short form. MUS is a widely accepted tool for sample selection. So I need not to get into the details on how this MUS sampling tool is working. But I know that this MUS tool is my firm approved tool, my regulator approved tool. This is a practical tool that is being used in the system. So I can simply, rather than involving an expert, right? I can I can take the license of that tool and I can make it a part of my audit practice. This is what happens in practical life. Okay, so it's not like you are involving expert for everything, but yes, those tools which are developed by experts, you can use them, but only if they are approved by your regulatory bodies and then the regulators itself. I'll take another example. Okay, I I hope I'm able to answer because this is what practically happens. Yeah, but I'll take another example. Like there's a I'll not say tool, but there is a platform which is known as confirmation.com. Okay, this is a global platform which is used to collect the confirmations. It can be used to gain the bank confirmations, data confirmations, and everything, and it is globally widely used. Over there what happens, these confirmation.com people, they go to respective banks or they go to respective debtors or creditors, the different companies basically, and then they register them with their email IDs and all. And as an auditor, if I want to kind of send a confirmation to a bank, I need not to go through a kind of a manual model or drafting confirmation and circulating them. I can simply log in, take a license from the confirmation.com, and I can use that. So if I'm sending a mail to, let us suppose, a bank which is registered with confirmation.com, the bank also knows that confirmation.com tool is used for confirmations. They will reply on to me on this. Now this tool, which is an auditor's tool, I will say, this is a widely globally accepted tool, but we are still waiting in India the regulators to approve this. So while if I'm doing the audit of a US client, I can still use that tool to send confirmations of bank or ARs. But if I'm doing the Indian client's audit, I cannot use this tool. Okay. So this is how we work basically. So as an auditor, there are multiple tools and the technology that you use internally.
Great explanation, sir. Very good, sir.
Yeah.
Yes, sir.
Okay. So I was actually practical about it that I'll not be able to cover all the four FSLIs, but we can nevertheless cover those FSLIs in the next session as well. But at least we can try in the next 20 minutes to cover up that third FSLI, okay, which is not a very big FSLI, but still it is very, very important. So I'm moving to the third FSLI, which is known as accounts payable, trade payable or accounts payable, okay. So let me just quickly open that. Yeah. Now, what do you understand by trade payables? I mean, very simple that these are the outstanding of the payables, which are vendor payables. These are against our purchases. Since trade payables is a balance sheet item, but the purchases is a P&L item. So we need to be very careful. Are we doing testing of trade payable or are we doing the testing of the purchases which are in the P&L? When we are talking about trade payable, since it is a balance sheet item, we have balance sheet related assertions. So we need to go with those kind of assertions which are there. But over here, when we are talking about the trade payables, we are covering both. Okay, the way we covered for P&L, both the line items, the balance sheet item and the depreciation P&L item. In this case as well, we'll try to cover both of them. Trade payables, it means we are checking the balance sheet assertions as well, and we are checking the assertions related to purchases in the P&L. Now, they can be completeness. Liabilities not recorded to understate expenses. You see, my liabilities are understated. Always remember, in the asset side, on the asset side of the balance sheet, as an auditor, you have always a risk of management doing overvaluation. Management will always, I mean, this is what the kind of a presumption that an auditor always have, that the management will always try to overvalue assets while they will always try to undervalue liabilities. It means when I am checking assets, my whole focus, the major focus of my efforts will be on checking whether the values they are there, like assets that are there, whether they exist or not. Existence is a very big problem over there, whether they exist or not, right? But when I'm talking about liabilities, I will not be focusing that much on existence, but I'll be focusing my whole efforts on the completeness, because there is a high probability that management will try to hide some liabilities. I hope this is clear. But again, I'm not saying that undervalue or overvalue is that would we as an auditor we need to think, because our audit procedures need us to address misstatements. It's not understatement or overstatement. But I'm telling you, it is a presumption that we take as in the practical world that management will always try to overvalue assets and undervalue liabilities. Okay. With this kind of a thought, we can move ahead and we can see like trade payables, completeness is an assertion. It means the liabilities which are there in the books, they are not complete. It means the risk is basically that liability is not recorded so that they can understate expenses. Understating expenses will give them better profit figures, better bottom line. So how as an auditor you avoid this situation? How will you identify that there is some liabilities which are not recorded? We call audit procedure. There is an audit procedure known as search for unrecorded liability. Again, a very important question that you might face in the interview, right? As a qualified, as a student, if you'll go there, this is one of the favorite questions in the industry. That how you perform search for unrecorded liabilities. Okay. Now, before I'll move to the Excel and will show you how we are documenting that testing, but we need to understand how you can check that there is something which might be missed in the books of account. So what we do, especially like in the cases of accrual, provisioning, and all those kind of statements, but try to understand. Let us suppose there is an electricity bill which will come later on, because for March account bills may come somewhere in the April. There is a probability while doing the provisioning of March, I might have missed this particular bill to be recorded. So what we do actually, subsequently, this bill must have come to the company and the company must have paid this particular bill. So what we do actually, we do the subsequent testing. We call it subsequent payment testings. It means all the testings, all the payments which have been paid subsequently. After the March, we will pick up the bank statement of April and we will see whatever the payments are being made, whether there is any expense in those payments that was related, relevant to the March, to the previous year. And if we will come across any such expenses which were related to the previous year, we will see whether this is recorded in the previous year or not. And if it is not recorded in the previous year, we will go back to the management and will ask them to record this. That is how you do search for unrecorded liabilities. Because we believe that the vendors, they will not leave the company without having having it booked in the books. It means even if company has not recorded, they will definitely ask for the payment. So the company has to pay anyhow. So whatever payments company is making, from there we will check whether the liability was supposed to be recorded in the previous year and whether they have recorded it or not. I hope this completeness thing is clear. Existence, it means whether the liabilities which are there in the books, they may be by fraud or error. There is a possibility they might have been recorded double, duplicate, or there are fake bills which are there. Okay. So let us suppose management is actually putting up some fake bills, some liabilities which can be there to create some level of fraud, or embezzlement of funds can also be there. I mean, in one of the company that I audited, this audit actually converted into investigation, and then we realized that there are a lot of bills which were fake and they were recorded by the company in the books of accounts, because the payments which were being made to these bills, they were being taken back in cash by the company after giving some margin. So those vendors were actually just helping the company rotating the funds rather than having the actual liabilities, right? So this existence is also a very important thing. Obtain vendor confirmations and verify invoices. That's a procedure. How will you check whether the liabilities which are there, they are genuine or they are fake? So what you need to do is vendor confirmations and then invoice verification. That's what you do. In some kind of situations, we also in that case, we check the subsequent vendor payments. So if there is a vendor which is paid subsequently, that's also a kind of a audit procedure that we perform. Then we have cutoff. Cutoff means wrong. Uh, okay, I think this is a mistake in the PPT, but
The student is asking कि
yeah,
फेक
yeah, please.
इनवॉइस फेक वेंडर का कैसे पता लगेगा? थोड़ा सा और इसके बारे में एक्सप्लेन कर दीजिए.
Okay, fake invoices or fake vendors. So what happens actually? You see, when we are receiving invoices, I'll give you a practical example. So when we were doing audit of one of the uh, very famous hotel, I'll not take the name. Now what happened actually in that hotel, there is the bills which used to come. Okay. So what happened, the first comfort that we need to take is when company is recording bills, fake vendors and all, how are they ensuring? What is the way the company is getting a comfort over that, right? So there are internal controls which are there. You see, I'll take an example of that company. If there is a new vendor which is to be registered in the ERP or SAP, or it is to be added in the bank account for the automatic transfers, there is a whole process around it. I mean, what is the purpose? Why that vendor is required? I mean, what kind of services this vendor will provide? How and who selected that vendor? Whether that vendor has passed all the vendor validation steps. I mean, there is a kind of a whole checklist that the company has to go through before they register any vendor in the vendor management database, right? So that is the first step. So to identify a fake vendor, you need to first see whether that vendor database or validation is appropriate or not. That is the internal control. I think if you can recall last session, I did mention that if you really want to see whether a fraud is there or not, there are three things that you need to see. The first is whether there is any opportunity or threat, opportunity or incentive which is there, right? So if you realize that the management is there under a pressure or incentive, then there is a probability some fraud will be there. The second thing that you need to see is that the internal controls, whether the internal controls are giving an opportunity to the management or not. If the internal controls are strong with the company, then the fake vendors will not be there, right? And then the third one is the rationalization. Coming back to the internal controls, it all starts from there. So what companies, the bigger companies where the thousands of vendors are there, they are very cautious. A very stringent kind of internal control system they have in place before they register any vendor inside the system to make any payments. Okay. Even if that is happening, there is a inbuilt automation controls and then manual controls as well, which goes like three-way matching. I'm not sure if you have heard this. That's a very important kind of a procedure that every company they kind of follow. So what happens when when they are receiving a bill from a respective vendor, that bill comes along with the products. The products goes to the quality department while bills goes to the purchase department. So they have a kind of a whole process. Okay, just to give you a better understanding again, like if somebody wants to purchase a laptop, you know how the process is. Just to give you how robust the process can be, it is like first of all there is a requisition that will be raised by a particular department. That requisition will be signed by the head of department of that particular department that they need. This requisition will go directly to the store and maybe the asset department where the laptops are being stored. Now, the asset department will see whether the asset is in stock or it is not in stock. If it is not in stock, a PO will be, they will send a requisition to the purchase department. Purchase department will see whether they have an agreement in place with any existing vendor, whether a global agreement is there or a, let us suppose, country level agreement is there. If there is a vendor with whom the agreement is there, then how to proceed further. If the vendor agreement is not there, then probably the process, which generally may involve the three quotations, four quotations, five quotations, and on the basis of the quotations they will be receiving, they will ask the vendor database to register them in the vendor management system. Now, once the vendor is registered in the vendor management system, they will raise a PO to that vendor. The vendor against that PO will create an invoice and they will send that invoice along with this particular product to the company. The company sends that those products with one copy of bill to the quality and inspection department to ensure that the quality of the products are intact. The another copy of the bill goes to the purchase department so that they can close that particular purchase order. And third copy goes to the finance department so that they can receive they can record this in the financials. After doing the quality and inspection, the quality and inspection department sends it to the store department where they record that the asset is received and then it is issued to the respective department from where the requisition has come. I mean, they create very systematic and very robust system. How beautifully the internal controls are being are there, designed, implemented, and operating effectively will definitely gives a level of comfort to the auditor that this thing is not there. Fake trade tables are not there. Fake vendors are not there. But even if all this system is there and if a management wants to do the fraud, they can still do it. And to avoid that, as an auditor, you do a three-way match. Okay. And those three-way matches are like you are receiving goods and you have a goods received note, which is the quality and inspection department basically that they are signing that they have received the goods. On the other side, you have a purchase invoice, which is recorded by the by the finance department. So you see that that purchase invoice is actually showing the same products which the quality and inspection department has received in the GRN. So that's the second check. And then you see that the purchase order which was generated by the purchase department, that is also matching to your invoice and to the GRN. So invoice, PO, invoice, GRN, all three are matched to ensure the fake vendor is not there, along with the testing of internal controls. That's what we do in the practical life. I hope I answered it, you know, how to avoid these fake vendors.
यस गीता, होपफुली सर ने बहुत अच्छा समझाया सर. थ्री वे मैच सिस्टम जो आपने बताया सर, बहुत ही अच्छा प्रैक्टिकली बताया. तो होपफुली गीता कालिदास पटेल, आपका क्वेश्चन ब्यूटीफुली सर ने आंसर किया है, होपफुली क्लियर होगा. यस सर.
So in the practical life, this is how we do. Coming back to, I will quickly show you what is the trade payable template looks like when you are doing the trade payable testing. Okay, so you see all those audit procedures that I just explained. This is how you document them. Okay, so it all starts with the lead sheet. What is a lead sheet? I just explained. It is just a summary of the trial balance, especially related to this FSLI. That what are the GLs which are there in the trial balance. So these are the GL codes, GL description, and what is the amount, right? And what is this matching with the financial statement? So that I know that in this work paper, I'm only testing these three GLs. Okay. And then there is a lead sheet controls sheet as well, whereby all the lead sheets are clubbed and then we are comparing it or doing a total that it is zero, it is matching with the trial balance. So that this is not missed. I mean, we have a scope that at a later stage, somebody will come up and they'll be like, sir, we were not able to allocate this or there was a confusion. So these GLs are left for testing. I mean, all the trial balance should be allocated on the day one itself among the team members who will be doing what. These are the assertions that we'll be testing. So we can make a list of the assertions as well on one of the tab, existence, completeness, and all this. Subledger to GL Rico. Okay. I mentioned when I gave you an example of subledger of assets that there is transactions which are posting in the subledger. But if somebody will by mistake or will post, we call it MJE, manual journal entry. When you are not using the right path of passing entries. So if I'm passing an entry in XYZ vendor's account, it means it is a subledger. But there is a high probability that at the end or closing month end, somebody will put the entry into directly accounts payable register, right? APGL. So if I'm doing an accounting APGL kind of an entry, it is an MJE which somebody posted. So the balance of the AP will become 100, but when we'll go and extract the sub ledger from the system, now this will not match 100 because in the GL there are some manual journal entries. So in those cases, your sub ledger report will not tally with the GL report, and this can create a very big problem if you will rely on the sub ledger report and will do all the procedures because you just missed to reconcile it to ensure that completeness is there, which I explained. IPE's completeness and accuracy should be first before you move ahead and do any audit procedures. Okay. So this is basically that sub ledger to ledger repo and to identify any manual journal entries which are passed by client. Then this is external confirmations. We may ask the vendors to confirm the closing balance. So we can send it and then whatever responses we have received, we can compare it with the ledger balance. Vouching post year end, right? So this is I discussed about search for unrecorded liabilities. So anything that is recorded at the end, we need to test, and anything subsequent payments that we are making, we can test them to see if they belong to previous year or not. Foreign exchange gain or loss only if you have some vendors which are, I mean, from a different currency, country they have come. Like this Onda, just to give an example, like this Onda is a website which is generally used to take the exchange rates. So if somebody is asking, generally this is right. So like if it's an Indian client, then we can go to the RBI site as well. But RBI site does not show you all currencies. They have only limited currencies, couple of currencies. Onda is a website which shows you on real-time basis all the foreign exchange rates. And then this is an approved kind of a website which everyone is uses, even Big Four and all. Vendor aging, you can see if there is a vendor aging. I mean, for customers, aging is more important. For vendors, it is not that important. But you know what may happen, like if there is some customers or some vendors, sorry, which are beyond 360 days, they are outstanding. There is a probability that these are the disputed cases. Okay, so you may go back to the company and then you would definitely like to check that why are they standing for so long. There might be a situation if company is not making the payments, there can be a penalty or maybe a liquidity damage or maybe XYZ liabilities that may come to company at a later stage, or maybe these guys may come up with a claim of interest, right? They might be, they are disputed, so maybe some litigation things are going on, some claims from their side is there. So if these are pending for so long, this might arise to contingent liability as well in the books, which you need to show in the notes. Okay, so we need to be very careful. I mean, if it was a debtor, I would have gone with a provisioning. I would have asked the client to provide it in the provision 100%. But since it is a creditor, I can't go back and tell the client to reverse it and book as a revenue or probably other income in the books. We generally don't do that because as an auditor, we have to be conservative. For debtors provisioning, it is expense. For creditors reversal, it is a other income. So we should not do that. Aging comparison, okay, that's the same thing basically. Aging recalculation, if you want to do a recalculation. IPE testing, anything that you receive like sub ledger to ledger. So when you are doing the testing of sub ledger, it is the information produced by entity, IPE testing for that. And then somebody was asking me, so this is the sample methodology. I mean, this is blank, but what happens in the sample methodology, I told you, like there are softwares which we are using. So how many samples will be expected and what is the tool and how those tools will run is something that we use for samples, exact sample selection. So this is how you do the testing of accounts payable. I wanted to cover another like statutory dues as well, but we will cover it in the next session. So I'll put like 2, 3 more FSLIs, and then we can cover that in the next session, which is going to happen on the Wednesday.
Sir, one
So,
student is Samay Nathan is asking,
yeah,
for
please.
cutoff purposes, which date we should consider? Invoice date, GRN date, PO date. Is it
So,
mandatory that all the 3 dates must be on or before 31st March?
so you see, again, what I was telling you when we were doing the revenue. So, you know, okay, what happens that invoice date may be different, GRN date may be different. Okay, PO date may be different. They will never be same. You see what happens today. Samyanathan, let us suppose you have a company. Today I am giving you a PO. I'm saying Samyanathan, I need this. So PO date will be today's date, 21st February. Now your team will receive the PO maybe today or tomorrow, and tomorrow they will create a SO, which is a sales order, right? So they will create a sales order maybe tomorrow, but they will send it to factory, warehouse, wherever the goods are there. And once it will reach the factory warehouse, then the invoice will be generated. So they may generate the invoice after 2 days as well. So that will be at a different stage. Now they will dispatch those goods. So when then they will dispatch those goods, the GRN is something that company will create when they will receive it, right? Then only it will create. Now what we need to do for cutoff, Saminathan, we need to understand the terms of purchase, right? That's what is really important. If terms of purchase is like the goods will belong to me, the moment an invoice is generated, it means risk and reward is transferred. If something will happen to those goods which I have purchased but they are on the way, then that is my actually stock, or that is my asset, right? In those cases, even if they are on the way, what I need to do is I need to pass an accounting entry. That is the liability that I need to book. I have to actually record that particular stock in transit, and then I have to record that purchase in transit, and then I have to credit you because now invoice is there, so I am required to pay. In the practical world, generally what happens, I don't own those goods until they are receiving to me. It means until GRN is created. So if the terms are like they will become my goods when GRN will be there, I mean when I will receive them, then if those goods are on the way, then I will not book any liability because that's not the liability belongs to me. If something will happen to those goods, it is your loss, your property. So you should be booking sales nor I should be booking purchases. This is that simple. So, or depending on the terms, but yes, to give the clear answer to you, generally we should keep GRN as the base unless I have not received goods, I should not be booking my liability in the box. Right? But yes, all 3 dates, there is a high probability they will be different. PO, invoice, and GRN, they may have different dates. Okay, Samanathan?
Yes, sir. Nicely explained, sir. Great.
Okay, then I'll go back to Rajiv, sir. I think we have come to end today's session. I think it was fruitful. I tried my level best to give the insights, whatever I was able to share. I know it is practically impossible to bypass or to give you all that knowledge that we are doing on ground, but at least it has given you some glimpses of what is exactly happening in the practical world outside. Over to you, Rajiv, sir.
Yes, sir. Sir, great explanation of the concepts and practical insights on audit, sir. Great lecture, really. Great session. Next session is on 25th
Fifth,
of February,
yes,
Wednesday. तो स्टूडेंट्स
right.
आप थोड़े कंसेप्ट जो नेक्स्ट लेक्चर के जैसे सब्सटेंटिव थोड़े से आप उनको अगर रिवाइज करके थ्योरेटिकली करके आओगे तो आपको और ज्यादा बेनिफिट होगा. स्टूडेंट्स ने बहुत अच्छे क्वेश्चन पूछे हैं. तमेनाथन, गीता, all of you students have put good questions. Or sir, thank you very much, sir, for I think I should say a great teaching, great delivery by sir. Thank you very much, sir.
Thanks a lot, sir, and all the very best to students. Looking forward to see you in the next session. Take care. Bye.